Good morning, everyone.
Good morning, sir.
Good morning. Good morning. Let everyone join in. In the meanwhile, I'll just take the MTP handout. All right. Good morning, Kirtana, Deepika, Anamika, Sudha, Rafiq, George, Guru Nirupama, Bhavya, and all of you friends. Good morning, everyone. Let me just check. Yes, this is the MTP that we need to solve now. All right. Good morning, Arjun. Fine. Friends, this is a question that I told you. It's a beautiful question. All right. Lot of calculations are involved, and it's a question on international financial management. Okay. I don't want to start directly with this. No, 1 hour will go off. Sometimes we don't know how much time it will take for this one question. Let me do the remaining problems, after which we will come back to this question. All right, friends. So I believe everybody has joined in. Can we positively start off now? Okay, let us start off. Let me mute everyone first. Perfect. I have muted all of you. Perfect, friends. So let us start off now. One, we will do it after some time. Let us start with question number 1B. It is a question on dirty price. I have done it in my regular class, in my crash class also, if I'm not wrong. Okay, if not done, we will do it now. So this is a conceptually, it's a different question. It is basically a repo. So I will explain the logic and parallelly we will do it. Okay. Yes. All right. Let me just start off now. 1 moment. Let me take my notepad. Super 25 is over. Now MTP. George, you sent me a doubt regarding yesterday's thing in the group, right? What was that, George? Can you please raise your hands? Why is capital expenditure coming twice? It is not coming twice, George. I believe that's sorted out. It's clear, right? Okay. Right. So I think we are doing MTP session 2 right now. Correct. Okay. MTP 2 we are doing. Okay. Let's do already a name with that. MTP part 2. I think part 1 I haven't got it. Somebody will have to help me with MTP part 1. Okay. These files are, I'm not able to download now. Earlier that was possible. Now they have made some, they have to log in and get the details. So that's making it a bit difficult for us. All right, let us start off now. So I'll do question number 1B. Working note number 1. Basic data. So here bank A is entering into a repo with bank B. So here you have bank A. They are entering into a repo with bank B. So when they say entering into a repo means bank A is giving a loan to bank B. That is the meaning of repo. All right. For a duration of how many days? They are giving it for 14 days with bank B in 10% government of India bonds. So that means they are going to give 10% government of India bonds will be given as security for this. So this is the underlying asset also. So the loan amount will be decided based on this underlying asset. All right. Fine. So I think once you are put up with this, then they are saying over here at the rate of etc. Rest I will write down in the next page. Can you please put this chart in your books? Thank you, Guru Nirupamam. You have given MTP questions 2, MTP 2 answer. You have shared 4 files, Guru Nirupama. Which one is part 1? How do I know? Let me just check. Okay, I think I've got it. Perfect. I believe you're all done with this part. Now let me write down the basic data. So that was basically the understanding of the question. Now I will write down working note number 1, basic data, point number 8. So here I'll write down the duration. What is the duration that you have over here? Do you have the duration as 14 days? Correct. And 10% GOI bond is the underlying asset. The interest rate is said to be how much percentage? 5.65 percentage for 8 crore. So the nominal amount or the value that has been told over here is 8 crore. Friends, 8 crore is the GOI of India bond value. This is not the loan amount. This is the GOI bond value. All right. So that is 8 crore. Assume that the clean price, the price that does not have accrued interest. So the clean price is 99.42. Is 99.42. Then they have told initial margin is 2%. Okay. All this I will explain to you. Accrued interest is how many days? Accrued interest 262 days. Friends, just a moment. Is this lighting 1 minute? Let's just it gets normalized. Is this lighting comfortable? Are you able to see me, or should I put the other light also? This is okay and comfortable, right? Okay. All right, fine. This is getting recorded. Okay. So 262 days. All right. Accrued interest is 262 days. Let me come down. You are required to find out the dirty price and the repayment values, what they are asking over here. All right. So I have put up the basic data over here. Now, based on this basic data, let me go to part number 2. Here I'll draw a diagram so that I can explain this to you better. All right. Then okay. So next what I will do is, sorry, I think. Okay. Leave it. This won't work. Leave it. I'll take care of that. I'll just remove the automatic shape. Right. So now, friends, after I've drawn this first day, I'll call this as T0. This automatically T0. On this date, what is the price they have told over here? Is it told to be 99.42, friends? All right. 99.42. They have told that how many days are there over here? Do you have 262 days? Correct. So what happens is for this 262 days on the government of India bond, which is the underlying asset, there will be a coupon amount that will come. So that will be 100 rupees into 10% into 262 divided by, I think 360 days is what they are saying in the question. Divided by 360. So can you tell me how much is the accrued coupon that you get over here? Do you get the answer as 7.27? That along with 99.42 will give you the answer as 106.70. All right. So that is this price. If this price is what you call it as the clean price, along with coupon, this price is what we call it as the dirty price. Now, why we do this dirty price is because what is the actual bond value that is given in the question? Is it given as 8 crore? Correct. So on this 8 crore, what is the face value? I believe that's 100 rupees. From this, what is the number of bonds that you can find out? How much is 8 crore divided by 100 rupees? Do you get the answer as 8 lakh bonds? Now, these bonds are issued to the other fellow at the dirty price. So, what is the dirty price that you have? 106.7. Therefore, what will be the loan amount given by Bank A? That will be 8 lakh into 106.7. Do you get the answer as 853.60 lakhs? But from this, we are supposed to reduce the margin of how much percentage? 2%. That will be 17.072. So once you reduce this, what will be your net loan amount? $836.528 lakhs is going to be the amount. I'll give you a minute. Please scribble down this. Hold on. Mock test paper, there is 1 and 2 only, right? So here is told September series answer and the question. Okay. All right. Right. Fine, friends. I believe you are all done with this part. Can I go to the next one now? All right. So once you, okay, I'm doing the October series, right? You want me to show the chart again, Pravina? Yes, please draw the chart. I'm now coming back to the chart only. So here you get 836.528 lakhs. So here the loan amount is 836.528 lakhs. On this, you are going to pay interest at the rate of how much percentage, friends? 5.65%. So 836.528 into 5.65% for how many days? For 14 days, correct? So how much will be the interest that you will end up paying over here? 836.528 into 5.65% to 14 by 360, 1.83, correct? So this plus 1.83, if you do 836.528, you get the closing amount of repayment as 838.36 lakhs. So we are done with this question, friends. This is what I've put in diagram. You just have to put it right step by step. Loan amount to be taken this much, add interest, etc. But chart, stays in your mind. Please write down and finish it off. In exam, you can draw charts, but with pencil, and ultimately for what you write only, you will get marks, okay? All right. Can I go to the next part now? So we are done with this question also. B is done. Okay, C is a theory question. What do you mean by counterparty risk? It means you do your part, the counterparty doesn't do his part, is what we call it as counterparty risk. That theory part you can focus. I have done this in the theory marathon. Okay. Now, here I'll go to 2A. That is a question on valuation. Friends, value of any company is nothing but present value of future cash flows. Am I right? So, question 2A, working note number 1. Basic data. AB is going to acquire XY. So AB is a big company, XY is a small company. The valuation is to be done based on the recommendation of merchant bankers, and the consideration is to be discharged in the form of equity share. The paid up capital of AB Limited is 80 lakhs. So capital of AB Limited is equal to 80 lakh shares into what? 10 rupee each. So do I get the total value as 800 lakhs? Correct. Next, they have told over there, the highest and the lowest market quotation for the 6 months is 570 and 430. So highest MPS 570, lowest MPS is equal to how much? 430. For the purpose of exchange, the price is to be taken as the average. So what is the average MPS for merger? That will be 570 plus 430 divided by 2. Do you get the answer as 500 over here, friends? All right. So once you get this 500, down they have given the balance sheet. Why do they normally provide you with the balance sheet, friends? Only to get the total net assets. So I'll write down total net assets. I think total net is not a good word. Net assets. How do you find out the net assets? You will take the total assets, that is 350 lakhs minus 100 lakhs. So you get the answer as 250 lakhs. All right. One more thing that you need to observe over here is this, friends. Do you see that you have 10 rupee fully paid up? And down you are having 5 rupee fully paid up also. So basically XY is having two types of shareholders. One fully paid up, other one partly paid up people. Down they have given you the future cash flows. 1, 2, 3, 4 and terminal value is given. Everyone interact with me here. Okay. This is going to be year 1, year 2, year 3, year 4, year 5. What about this? Terminal value will also be year 5 only. Everybody clear with this part now? All right. So down they have told it is the recommendation of the merchant banker that it has to be valued on the average of DCF and net assets method. So I'll write down over here. Value should be the average of DCF and net assets method. All right, friends. Fine. So I believe you're all clear with this part now. Can I go to the next one? Okay. Yes. Let me go to the next part now. So here, once you are done with this part, they are asking you to find out the value of the business. So I'll write down working note number 2. Working note number 2, I will write down value using DCF method. Okay. Here, cash flow, discount factor, discounted cash flow. So year 1, you have 105 lakhs. Year 2, you have 120 lakhs. Year 3, you have 125. Year 4, you have 120. Year 5, you have 100 also, 200 also. Total will become how much? 300. And the discounting factor is said to be how much percentage? 8%. So it will be 0.925, 0.857, 0.793, 0.735, 0.680, 97.125, 102.84, 99.125, 88.20, and the last one is going to be 204. One 102.84, 99.125, 88.2, and the last one is 204. 591.30 lakhs is what is going to come over here. Everybody clear? All right. So once I get this, I will put it here itself. Working note number 3, we need to find out the average value. So what was the value using net assets method? Do you get the answer as 250 lakhs? Friends, in bracket, give the working note reference, okay, from where you got it. It was in working note number 1. Then you write down value using DCF method 591.3. Therefore, what is going to be their average value over here? Do you get the answer as 420.64 lakhs? Correct? Okay. So once you get this, they are asking over here, calculate the total value of business. We got 420.64. Number of shares to be issued and the basis of allocation. So that is the final working note now, friends. Okay. So here I'll write down the next working note. Number of shares to be issued. Okay. So now let us do this. What is the total value that we got over here? 420.64 lakhs. We agreed to issue shares at a rate of 500 rupees per share, correct? Do you get the answer as 84,128 shares? Correct. So once you get this, we have to split this among two types of shareholders. As I told you earlier, they are having 10 rupee fully paid up people also, 5 rupee fully paid up also. So what I will do is 20 lakh 10 rupee fully paid up. 10 lakh is partly paid up. So here I'll write down 20 lakh shares. 10 lakh partly paid up, I will take it as 5 lakh shares. That is the equivalent number of shares that we are trying to work out over here. Okay. So 84,128 divided by 25 into 20, if you do, here you will get 67,302 shares. Okay. And this only 5 lakh shares will be given to these people. So that will turn out to be 84,128 minus 67,302. That is 16,826 shares. I'll give you a minute's time. Can you scribble down and finish it off? Wait, you want the previous slide? Yeah, please do this. Can I go to the next part now? Loganathan, are you done? Okay, please do this now. All right. Fine. Friends, I'll be sharing the notes anyway. So just scribble along with me, okay? So otherwise, what will happen is, it may get stuck. Yes, Guru Nirubama, many questions come from the regular material because that is made after taking the past 5-10 years and, understanding the exam trend. All right, friends. Are you all done? Yes. Can I go to the next part now? Yes. This question also, if I'm not wrong, we have done in our regular class. Okay. And the crash also. They have given the security, the price, number of shares, and beta is given. Wait. Part 3 is done, Sarvamangala. That's what we did over here. This answer, what we got, is the basis of allocation. Yes. Okay. All right. So I think we are done with that. Let me go to the next question. Question number 2B. So I'll write down over here question 2B. Friends, this question is ditto from our material. So we'll do it a bit faster than the normal pace. Okay. They have given the price, number of shares is given, and beta is given. So from all these things, what are we supposed to find out? Tell me. My regular students, please interact with me. Yes, overall beta. That's what you get over here. Okay. One moment. I want to take an Excel sheet. Okay, so now let me put the numbers that we have over here. You have security, then you have price, then you have number of shares, then you have beta. Okay. All right, so what are the securities? You have A, B, C, D, E. A, B, C, D, E. Price is 349.3, 480.5. Next one is 593.52, 593.52, 734.7, and then 824.85, 824.85. Now, what about the number of shares? They have 5,000, 7,000, 8,000. 8,000, 10,000, and 2,000. Okay, what about the beta? You have 1.15, 0.40, then you have 0.90, then you have 0.95, and then you have 0.85, correct? So from this, first, what will I do? I will find out the market value. Okay, so what will be the market value? This multiplied by this. You get this answer, and then I'll take the sum total of this as this much. So you get the answer as 188.54 lakhs. Friends, one mistake area, please remember 188.54 is your spot value of the portfolio. S0. This is your S0. But what happens is in the question they have given index also, so you get confused over there. All right. So this is a market value. From this market value, we take the weight. So the weight would be this divided by fine. So you get the total as 100. So next, what will I do? I will do beta into weight. Okay, so that will be this multiplied by this. So I get the overall beta as how much, friends? I get the overall beta as 0.85. Everybody clear with this part? I think I'll make it in 2. Perfect. So can I just copy paste this now? So we get the overall beta. Perfect. So we got the overall beta over here. And just remember one very, very important thing. People always go wrong. This is the spot value of the portfolio. Everybody clear with this part? Okay, next one. So once you get this, I will go to the next part of the question. Now they are asking the beta of the portfolio. We got the answer. Theoretical value of Nifty futures. This is where people get confused now. Working note number 2. Theoretical value of Nifty futures. Okay. So here F0 of Nifty. So Nifty future will be equal to S0 of Nifty, not portfolio. All right. This into beta. No, sorry. I have made a wrong formula here. That's a hedging formula. S0 into E raised to RT. All right. So here E raised to RT will be 0.105 into, that is 10.5% into, I think it's for 59 days, correct? January 1 to Feb 28 is 59 days into 59 divided by 365. 0.0169. 0.0169. So E raised to 0.0169 is nothing but 1 plus R square divided by 2. Do you get the answer as 1.02535? Therefore, futures of Nifty or Nifty future will be equal to 5,900 into 1.02535. I've made a mistake. 1 plus R square divided by 2. It is 1.071. 1.017. Okay. So once you do this, you get the answer as how much over here? You get the theoretical future price as 6,000. Everybody clear? Okay. Once you get that as 6,000, then they are asking the number of contracts of Nifty the investor needs to sell to get a full hedge. So now we are talking about perfect hedging. Next working note heading. So here we have learned the formula. Perfect hedging is equal to S0 into beta into 100%. So it is going to be S0 of what? S0 of the portfolio. Everybody clear with that part? So people make mistakes over here. What you do is you take 5,900. That is the Nifty value. Don't make that mistake. All right. So here it will be 188.54 lakhs into 0.85 into 100%. So do you get the answer as 160.259 lakhs? Am I right? Okay. Yes. Fine. So once you get this answer, we got the perfect hedging. Now here we have to find out the contract size also. Working note number 4, contract size. So what will be the contract size? You have told 200 units is the multiple and the value of one Nifty future is 6,000. So do you get the answer as 12 lakh? So once you get this, I will find out the number of contracts to sell. So that will be 160.259 lakhs divided by 12 lakhs. You get the answer as 13.35 contracts. But tell me, friends, is it practical to enter into 13.35 contracts? No, you can only enter into either 13 contracts or you can enter into 14 contracts. Friends, I request all of you to keep on talking there, okay? Let your parents think you have gone crazy. Write, talk, make it active learning, okay? Please scribble down fast. I just went to the series 1 question paper, friends. It's very easy. Only the first 1A. This thing 1A is a little bit tricky. Rest are all very easy problems, friends. Very, very quickly we can finish it off. Few we have already done. I think in Super 50, Super 25, we have done question number 3A. Already covered. Rest are all covered in our class, friends. Crash material or regular class. All same type questions have come over here. Previous slide. You mean this one? Okay, please do it. I'll just come in a minute. Perfect, friends. Can I go to the next part now? Let's do the next question now. Everybody clear, right? Next part, can I go? Okay. Perfect. So we are done with theoretical value of the future, and now we have done with the perfect hedging also. Number of contracts for a full hedge. I believe we have done that. Next requirement, what they are having over here is that what should you do to reduce the beta to 0.6? So I'll write down the next working note. How to reduce beta to 0.6. Come on, friends, tell me what are the steps that you will do in this case. Point number A will be current beta 0.85. Point number B will be what? Desired beta. Keep on talking, okay? Point number C is going to be what? Reduction. How much is the reduction? 0.25. What is the value in the spot market? That will be 188.54. Therefore, what will be the value to go short? 188.54 into 0.25. Do you get the answer as 47.135 lakhs? Correct? So number of contracts to sell, that will be this divided by 12. E divided by 12 lakhs. So you get the answer as 3.93 contracts. In reality, can we enter into 3.93 contracts? No. We can enter into either 3 or 4. Perfect, friends. 1 minute, scribble down. Friends, in my regular class, I have added 2 more additional requirements, which is not there in your MTP now. I have given proof of when 10% this thing falls down, how much the other thing falls. Correct? I think I'll do that also, so conceptually it will become thorough. Otherwise, this question will be half-baked. Let's not take 10%. You tell any percentage. You tell market is falling by how much percentage? Any percentage you tell, I will prove it to you that we'll get a perfect hedge. In requirement 3, why did we give 5,900 as a Nifty value? 1 minute, let me just check. Are you asking about here, Guru Nirupama? This one? Yeah. See, they are asking you to find out the value of Nifty future. How do you find out the value of Nifty future? S0 into e raised to RT, correct? So to get the Nifty future, I should take Nifty spot only, right? To get Zomato future, I will take Zomato spot. Yeah, 5,900 is a Nifty spot. Yes. F0 Nifty is Nifty future. S0 Nifty is Nifty spot. Jaswant, have they taken 58 days? Okay, wait, I have taken 59, is it? January 1 to January 31st is 31 days, plus 28 days are there in February, right? So that is 28 plus 31 would be 59. Am I right? Why have they taken 58 days here? They would have excluded 1 day. Jaswant, you can go with whichever you are comfortable with, okay? I don't think they'll cut your marks for that 1 day. So they would have excluded January 1st, maybe. Okay. I'm assuming that the contract is happening on January 1st morning. They can assume that the contract is happening on January 1st evening. Okay. Right. So I think we are done with this part also. Okay. Now, for proof purpose, I asked you a number. How much should the market fall down by? 8.5%. Sarva Mangala wants to be very much sure that whichever number we take, we will get the same answer. Let us take 8.5%. All right. So please interact with me. In the spot, what have we done? We have gone long for 188.54 lakhs. And in the Nifty future, I have gone short for a value of 160 point something, right? 160.25 lakhs or 26 lakhs. All right. So now we are saying that the market is going to fall by 8.5%. So what is 160.26 minus 8.5%? Do you get the answer as 146.64 lakhs? At this point, you will go long, correct? So here you are making a gain. What is the gain that you make over here? Do you make a gain of 13.62 lakhs? Correct. Now, what happens in the spot market now? Here we have a beta of 0.85, which means for every 1% change in the market, security changes by 0.85. So if it is 8.5% into 0.85 means this is going to fall by 7.225%. All right. So 188.54 minus 7.225% will give you 174.91 lakhs. So here you make a loss of 188.54 minus 174.91, 13.62 or 63 lakhs. Your net gain or loss becomes 0. So friends, whichever way the market moves, ultimately your gain or loss will be 0. Hence, you can sleep peacefully. Scribble down fast. Sarvamangala, I believe you are peaceful now. You can try with any percentage, it will work correctly. All right. So I believe we are all done with this. Can I go to the next part now? 6,000 is the Nifty future value, George. 5,900 is the spot value. 6,000 is the Nifty future value. Yes, Arjun. Fine. I think you're all done. I'm going to the next part. So we are done with this question also. Now they're asking what are the prime participants in the process of securitization. Friends, I have covered this with the help of some film celebrities. Very easy to remember. So just go through that session. You will be able to, correlate. In 3 hours, we will be able to finish it off. Okay. Now, only one brown chapter is security analysis. Advantages and limitations of CAPM. This is not covered in theory marathon. This is basically a question from portfolio management. So I think next time I'll do a practical chapters theory part. I'll do it separately. Only the theory chapters theory is covered in the theory marathon. Okay. Yes. Let us go to the next question now. Messrs Strong and AMC has floated a dividend bonus plan. Friends, we have done a similar type question in our regular class. Do you remember? Regular or even the crash class. Backward working. They gave the answer and we have to go back. Same thing. Easier than what we have done. So let's do it quickly. Dividend bonus plan on April 1, 2016. at a certain NAV. At a certain NAV is not given. Fund has a robust growth and declared a bonus of 1:5. So it's a bonus plan. Okay. Dividend bonus plan. So they've issued a combo plan where you have dividend also and you have bonus also. Second bonus is 1:4, has generated an average yield of 17.5%. Mr. Optimistic has made an investment of 16 lakhs before declaration of the first bonus and remains invested thereafter. Down they have given the data, but first NAV is not given. So what we will do is we'll first draw a table. Question number, I think it's question number what? 3A, is it? Okay. Working note number 1, directly I'll write down analysis over here. Okay. So I'll give date. I'll start with the date. So the first date is 1st April 2016. On that date, we need to check what is our opening unit. So what is our opening units on that date? We don't know, correct? We don't know. We only know the investment value, all right? From this opening unit, then in the floated a dividend bonus plan, fund has a robust growth and declared a bonus of 1:5 on 30th September. That is the second day. 30th September 2017, there is a bonus ratio of 1:5. Bonus ratio of 1:5. Okay. A second bonus of 1:4 on 30th September 2019. Again, there is a bonus of 1:5. Sorry, it's 1:4 now. This is 1:4 on 30th September 2019. The fund as on 31st March has generated an average yield of 17. Okay, so the yield is given. I'll come to the yield part after some time. 31/3/2021. Okay, they have also given the NAV data. Whatever is given, I'll copy paste. 85 on this date. Then you have 92 over here. And finally, over here, you have 100. Correct? Fine. Can you please put up the basic data? Sindhu, you have a doubt. Wait. In the previous question, they have given, let me check the previous question. 1.059. How much did we get? That's because they have taken 58 days. I think that is why there is a confusion. Into 58 by 365 will be 0.0116. Point 0998, 1.01598. Sindhu, I'll just, yeah, yes, Sindhu, can you please speak?
Sir, am I audible? Hello.
Come again.
Sir, actually, they have taken the 10.5% as continuously compounded, and they have reversed. They have calculated it as 9.98%, and on which they have taken 58 days. So 9.98% into 59 divided by 365. So they get the e to the power RT as 0.015858. So they have used the e to the power RT value given in the question.
So let me just do it that way and see. So you're trying to say the 0.0998.
Yes, sir.
Then it's coming to 1.014. It is not coming to 1.015. If I do,
yes,
1.0998 square divided by 2 plus 1.0998, if I do, I get 1.10.
So 58 days they have considered, sir. 58 days.
Oh,
So
okay.
9.98 into 58 divided by 365 comes to 1.5858%, sir. So they have used the e power RT given in the question itself.
I think I got your point. Okay. So then they have taken e power RT and they have done like this, is it? Okay.
Yes.
Okay. Do one thing. See, if the exam they provide you with a factor over here, you better stick to that factor. I went as a habit because in the textbook that it is done using 1.0169.
Yes,
okay. But
okay, sir.
Here they have used the word 10.5. When they give a factor, friends, stick to that factor. Okay. So our answer will be almost the same.
Yes, sir.
5,900 into
Everything is the
1.01.
same, but the value alone 5994 point something is coming.
Okay, so
But
the
otherwise,
Nifty value will turn out to be
yes,
5994, and then
yes,
into 200 will give you the answer as 11,98,800.
yes,
Is it?
sir.
Okay.
Yes.
Stick to this number. Whatever is given in the question, stick to that number. All right. Okay.
Okay,
All
sir.
right.
Okay, sir.
Thank you, Sindhu. Thank you for letting me know about that. Okay.
Okay.
Just what you're trying to say in this textbook, they have given an alternative way. So in textbook, are you saying that they gave a value and even after that they have done it using the alternative way? This textbook is creating a mess. What we have done is absolutely right. Conceptually, we are clear, but then when they give a value over here, okay, you can go by any method, friends. Textbook supports my methods, will go by either my method or this method. Any method is okay. How did they get ln value? Log value, I'm not sure. They would have taken the natural log or what. I don't know how they have pulled it back. Sarvamangala, just ignore that. At 0.998, if what Sindhu is saying is that 0.998, continuous compounding will be 1.105. But that's also not coming to one, it's coming to 1.1047. So they would have rounded it off. Okay, leave it. I think we go by our method is also enough because textbook is recommending our method. So nothing beyond that. Okay, right. Okay, let's come back to this question, friends. Got it, Maria. Both are correct. So let's not, worry about that. 85, 92, 100 is given. 1:5 is given. 1:4 is also given. Please scribble down this. And the closing units. Okay. Now, have they given the closing units anywhere? 1:4. They have only given the yield of 17.5%. Correct? All right, we'll do that. What's the life over here? I think it's 5 years. Correct? Right. So I'll go to the next page now. Can I go to the next page? Okay. Yes. So I'll write down working note number 2, analysis of yield. Here I'll write down investment. Everyone tell me how much is the investment that this fellow has made in this case. He has made an investment of 16 lakhs. Okay, point number B is going to be what? Yield. So what is the yield that you get over here? Is the yield turning out to be 17.5%? So point number C will be total yield for how many years? For 5 years. That will be 16 lakh into 17.5% into 5 years. Do you get the answer as 14 lakhs? Correct? So from this, can I find out my closing value? My closing value will turn out to be how much? 30 lakhs. Okay. We know the closing NAV also over there. How much is my closing NAV? I think that is 100 rupees per unit. Therefore, what will be the closing number of units that you get? 30 lakh divided by 100. So do you get the answer as 30,000 units? I'll give you a minute. Please write down this. Perfect, friends. I believe you're all done writing this. Can I go to the next part? Now, this part, I want you to do it yourself. It is 30,000 units here. Nothing is given, so your opening will be 30,000. If I come back over here, it's 30,000 units here. Now the ratio is 1:4. So some units of that 1:4, when I do, I should get the bonus units. So I'll just do 1 and let you know. So some x plus x by 4 should be equal to 30,000. So how much should come over here? Yeah. 20,000, no, 24,000 is it? Okay, so if it is 24,000 comes over here, divided by 4 will give you 6,000 units. Perfect. Like this, can you do a reverse working and finish it off? Friends, are you all done? So now we can actually find out the opening NAV, correct? How much is the investment this fellow has done? 16 lakhs, 20,000 units. So it is going to be 80 rupees per unit. Perfect. So we are done with this question also. Shall I go to the next one now? All right, friends, I'm going to the next question now. So 3A is done. Let's do 3B. 3B is a very, very easy question on options. Let's do it together. Question number 3B. Working note number 1. Basic data. Hari is holding 100 equity shares, which is being quoted at 210. So number of shares is equal to 100. Quoted price is equal to how much? 210 rupees per share. So total market value will be 21,000 rupees. Okay. He is interested in hedging downside risk of his position as he's going to sell them after 2 months. A 2 months call option is available at a premium of 6. So I'll write down call premium 6 rupees. And a 2 months put option is available at a premium of 5 rupees. Put premium 5 rupees. Strike price is how much? 220. Exercise price 220 rupees. Suggest the position Hari should take in the option market to hedge his holdings in the VCC Limited. So, what position he should take to hedge his holdings? So, he's having currently long. Friends, now listen over here. He wants to hedge the downside risk. That means if the price is falling down, he doesn't want to make a loss. So, which option should he take? Call option or put option? Think. Now the price is 210. If the price falls down, he doesn't want to make a loss. So what will he do? Will he take a right to buy or a right to sell? You have to take a right to sell, because if the price falls down, only if you have a right to sell, you will be able to hold back. All right. So we can give it over here. Working note number 2, strategy. There you can write down, if Hari is looking to hedge its downside risk, he should do what? He should buy a put option. Okay. Please scribble down this in your books now. All right, friends. Kirtan, I'll explain once again. See, now suppose in this case, the price is 210. Tomorrow, if the price is falling down to 100 rupees, you will make a loss, correct? In order to cover this loss, what will you do? You will buy a put option. What is a put option? Let us say at an exercise price of, let us say 200. So you have a right to sell at what price? 200 rupees. So tomorrow, if the price falls down, what will you do? Will you exercise or will you lapse? You will exercise, and you will be able to sell at what price? 200 rupees. Are you clear, Kirtana? If you read through my example, one example I had given in my workbook, Shahir Ranjit. If you go through that, that same story is given there also. Okay. So now what we will do is we'll say that 1 minute. Strike price is 220. Put option is having this thing. How many equity shares are there? You have 100 equity shares, correct? Have they told any contract size? No, 1 minute. They have given some premium to be paid is 5 into. Okay, fine. So here 100 shares are there, right? So what they are trying to tell you is that, okay, since Hari is holding 100 shares, we should buy put on how many shares? 100 shares. So what will be your put premium over here? That will be 100 shares into 5 rupees is the premium, right? So you will end up paying how much premium over there? 500 rupees. All right. Perfect. So I believe you're all clear with this part. Can I go to the next one now? Okay. Now, next question they are asking, okay, calculate his final position if after 2 months On the date of exercise, the actual market price turns out to be this one. So they want a payoff table. Friends, we have done a lot of payoff table in my class. What is the table format? Keep on speaking. S1, E1, action, GP, premium, and what is the last one? NP. So S1. What about your S1? Spot price is said to be 200, 210, 220, 230, and what is the last one? 240. Exercise price E1 is how much? What is the strike price that is told over here? 220, right? All right. So you have a right to sell at 220. Outside market is 200. Exercise or lapse? You will exercise because you can sell at 220. Outside market, you can sell only for 200. GP will be 20, premium 5, net profit will be 15. Here again, exercise 10 minus 5 plus 5. Exercise or lapse at the money 0 minus 5 minus 5. Lapse 0 0 minus 5 minus 5 minus 5 minus 5. All right. Can you please do this now in your books? All right, friends, I believe you're all done with this part. Can I go to the next one now? So wait, I think I can find out the total loss because we are doing it for 100 shares, right? So it will be 1,500, 500, minus 500, minus 500, and what is the last one also? Minus 500. One more thing, your textbook has done it. I'll just put that over here. So in the first case, he will sell at what price? 220. Second case also, he will sell at 220. Third case, he'll be selling at 220. Fourth case, he will sell at 230. Last case, he will sell at 240. Correct? So minus 5. Here he will get 215. Here also 215. 215. 225. 235. That is the number that he will get in your hands. Okay? So we are done with this question, friends. Can I go to the next one now? Jayanti, you want the previous slide? One moment. Which one to be followed in the exam means my format is enough. That every book they give it in different perspectives. What I have done is a standardized format which is as per your textbook only. You can follow that. All right. Can I go to the next part now? Let's start with the next question. Question number B is over. Now we will do question number 4A. Correct? 4A is a good question, friends. So I'll write down question 4A. Working note number 1. Basic data. So here they have told following information is related to convertible bond. We have done similar question in Super 25 yesterday also, friends. Current price is 1060 per bond. Price 1060 per bond, and they have given the conversion parity price is 53. Friends, conversion parity price, we learned this word yesterday also. That is basically once you convert this, you will get 53 rupees should be the price of one share. So ideally from this we can find out the conversion ratio. We will do that later, but just now 1060 divided by 53. So we can actually find out here itself conversion ratio, that is 1060 divided by 53. If you do, you will get the answer as 20:1. Am I right? 20:1 will be your conversion ratio. So once you get that, let me read the next part. They have given the conversion premium. Conversion premium is 10.41667. So basically what this means is that right now the price will be something. From that something, we have to increase the price to 53 because 53 is the conversion parity price. Okay, so maybe the price is 50 rupees, but the price should be 53. So we are giving a premium of 3 on the base of X. So how do you work out here is X be the value, or maybe I'll take the value as 53 minus X. X is the base price that gives you the premium divided by X should be equal to 10.41667. All right. So in other words, 53 minus X is equal to 0.1041667. Okay. So I believe this X, correct? So if I bring that over here, it will be 1 minus 0.1041667. So in other words, 53 is equal to 0.895833X. No, mistake. It should be, it will go as plus 1.1041667X. So X will be equal to 53 divided by 1.1041667. Did I make a mistake here? 48. I'm getting 50 as the answer. Did I do any mistake over here? Yeah, 48. Correct. It was a calculating mistake. 48 rupees. So this is actually the market price of equity share. All right. Let me continue reading through the next part. Percentage of downside risk with respect to the straight value of bond is turning out to be how much? 12.766. We'll do that separately. Can you finish off till here first? Please do this now. Fine, friends. I believe you're all done with this part. So I'll take a fresh page and now we will go and find out the straight value of the bond. What is the market price of bond that we already have in the question? 1060. Straight value is basically the present value of future cash flows, how much they haven't given over here. Okay. So I think in the question they have given you the premium percentage of downside risk with respect to straight value. So the downside risk will turn out to be 1060 minus X. So here the formula would be this divided by X, because you have told with respect to straight value is equal to 12.766 percentage. So 1060 minus X is equal to 0.12766 X. Therefore, 1060 is equal to, okay, so what is the value that you get over here? Do you get the answer as 940 rupees? Perfect. Let me cross check the answer, friends. Right, we have got all the answers correct. Write down and finish it off. We are done with this question also. I believe you're all done with this. Okay, so we are done with this question also. Let's go to the next question. Question number 4B. X Pharma has acquired an export order. Let's do this. Is a little tricky problem, but we can crack it. Okay, so I'll write down. What is the next question number? Question number 4B. Working note number 1, basic data. Point number A. XP Pharma has acquired an export order for 10 million. So I'll write down. Export order value is how much? 10 million rupees, if I'm not wrong. Correct? For formulations to a acquired an export order for 10 million for formulations to a European company. Company has also planned to import bulk drugs worth 5 million. 5 million rupees. The proceeds of exports will be realized in 3 months from now. So export will realize in 3 months. All right. And the payments to be done in 6 months. This fellow is a lucky fellow, friends. He gets money in 3 months. He has to pay the money after 6 months. 3 months working capital profit he will make. His cash flow will always be positive. Okay, 6 months. The invoicing of these exports and imports can be done in any currency: dollar, euro, pound, sterling, at company's choice. The following market quotes are available. So down they have given the quotes. Rupee per dollar quote is given. Annualized premium is given. Rupee bar euro, again the premium is given. And premium means always more. Alright, so we have to add 7% to the first one. Euro we have to add 6% and pound we have to add 5%. Okay. Advise XP Pharma about invoicing in which currency. So in which currency should I do the invoicing? Can you first scribble down the basic data? Fine, friends. I believe you're all done. Now I'll write down working note number 2. Analysis. First, we'll start with receivables. Okay. Analysis of receivables. So this is a slightly tricky problem. So just mark it. We are having three scenarios. I can either invoice in dollar or euro or in pound. So I'll write down particular. Okay. In dollar, in euro or in pound. Okay. So first I'll write down rupee receivable. So everyone tell me how much is the rupee receivable? 10 million means 100 lakhs. Correct. Point number B, friends, today when if I'm invoicing in dollar, tell me, will you use the bid rate or will you use the ask rate? George says ask rates, others are still processing. Let them process. Everyone says bid. George, you will have to rethink maybe. Let me check myself. See what happens is I will raise a bill in dollar. Dollar will come to me. Okay. The moment I get the dollar, what will I do? I will sell dollar. What is the bank going to do? Buy dollar. So bank buy commodity is going to be the bid rate. Okay. So it's the bid rate. So what is the spot bid rate? Do you get the answer as 67.1 in the first case? Second case also same thing will happen. It will be 63.15. And the last one will be 88.65. Okay. So now based on this, okay, I will put the invoice value. So tell me how much is 100 lakh divided by 63.1. 1,49,031 dollars. 1,58,353 euro. The last one. 1,12,803 pound. So once you get the invoice value, once you bill like this, I will get the money only after how many months? 3 months. So I will take the 3 months forward bid rate now, because if today I'm doing it bid, after 3 months also I'll get the money only at bid. Today the invoice value will be 1,49,031, but my forward bid will be 7% is per annum. So 7 into 3 by 12, I will have to do B plus, oh sorry, I cannot put it that way. 7%, I'll just put the premium percentage first. 7 into 3 by 12 will give you 1.75%. What about the second one? 6 into 3 by 12 will give you 1.5%. And what about the last one? 5 into 3 by 12 will give you 1.25%. All right. Now, once you get the invoice value and you get the premium, I can get the forward bid rate. So that will be 67.1 plus 1.75%. It will be 68.27. 64.09. 89.75. So once you get that, I can write down the rupee received at the end of how many months? 3 months. So that will be 149,031 into 68.27. I'll get the answer as 101,74,000. What about the second one? 158,353 into 64.09, 101.48 lakhs. Last one will be 112,803. 112,803 into 89.75. 101.24. So now tell me which is the best option among these three. Invoicing in dollar is better. How did you get point E? Point E is the forward bid rate. How I did that was, for example, in this case, it will be 67.1 plus 1.75%. I'll give you a minute's time. Please scribble down this. SVK, this premium is not like swap points. Wait, this premium is swap points only, but it's given in percentage, right? So when it's given as percentage, we have to add the percentage. If it was given in rupee per dollar rate, we would have added it directly. Now we are adding plus 7%, but 7% is for 1 year, so I take it only for 3 months. SVK, how did you write down like that? Bold italic? Is there a feature like that in Zoom where you can do it? Okay. Are you all done? Can I go to the next one? Okay. So I think once we are done with receivable, in the same way, now we have to do the payable. So I'll write down working note number 3, analysis of payable. Okay. Particulars. You will have dollar, then you will have euro, and then you will have pound. Now tell me rupee payable. How much is a rupee payable? 5 million if I'm not wrong, correct? 50 lakhs. Now tell me, in order to convert, will I use the spot bid rate or the spot ask rate? If the other one is bid, this one will be the spot ask rate. So what is the ask rate that we have? 67.2, 63.2, and the last one is 88.75. From this, I will find out the invoice value now. So what will be the invoice value? 50 lakh divided by 67.2, $74,404. Correct? What about the second one? 79,114 euro. Last one is 56,338. 339 pound. So once you get this, I will now have to take the premium. I think now we have to take a 6 months premium over here, right? So that would turn out to be how much? I think you will get the number as 3.5%. Then you will get the answer as 3%. And the last one would be 2.5%. From this, I can find out the forward ask rate. So 67.2 plus 3.5% will be 69.552 rupees per dollar. 65.096 rupees per dollar. 90.96 rupees per dollar. Are you all clear with this part? So from this, can I find out the payable amount? That would be 74,404 into 69.552, 5174,947. 51 lakh 74,000. Okay. 79,114 into 65.096. 51 lakh 50,000. And 56,339 into 90.96 will be 51.24. So tell me, friends, which is the best option among this? Euro will be the best option. No. Sorry. 51.5. Pound is the best option. Sana, how to know whether to multiply or divide? I'll explain to you, Sana. This is 50 lakh rupees, correct? This is rupees per dollar. So in that case, you're supposed to divide, because if you multiply, you will get rupees square per dollar, and there is no exchange rate like that. Guru Nirubama, but it is actually the other way around. I didn't understand Guru Nirubama. Wait, I think this question is quite confusing, which is the currency and the commodity. There is spacing in between and assume it as rupees by dollar. 1 minute. It is rupees per dollar, Guru Nirubama. It is not dollar bar rupee. Can you please raise your hands, Guru Nirubama? I'll just explain to you. It is rupee per dollar only, correct. What you have taken is correct. Just that 50 lakh rupees and the rate is rupee per dollar, so you will divide. Okay. Perfect. Shall I go to the next question now, friends? Okay, I think we are done with this. Let's go to the next one. Question number 5A. Indira. My online regular students and the crash students, you will be familiar with that question. Let us just finish off with this now. Indira has a fund of how many lakhs? 3 lakhs. Question number 5A. Okay, working note number 1. Basic data. Indira has a fund of 3 lakhs. So fund available is equal to 3 lakhs, which she wants to invest in the share market with a rebalancing target after every 10 days to start with for a period of 1 month from now. So rebalancing every 10 days. Rebalancing every 10 days. She has 3 close friends who has advised 3 different strategies. Buy and hold, constant ratio plan. CPPI is what? Constant proportion portfolio insurance policy. Since she immediately starts with investing in bond and equity and decides to rebalance her portfolio after 10 days and invest in Nifty as an equity component, Gokul, don't write on my board. Let me clear all the writings. Okay, it's cleared, is it? Okay. Fine. So now let me continue over here. So now here Nifty as an equity component which changes in tandem with that of the Nifty. So the equity share, if the Nifty goes up, equity will go up. Nifty comes down, equity will come down. As on the beginning date, the Nifty is 5326. So I'll write down over here opening. Nifty is 5326. And then they have told, and minimum Nifty within a month can be at most 4793.4. So I'll write down minimum Nifty 4793.4. All right. Now next part. CPC used 2 as multiplier. So here the multiplier will be equal to 2 times, or 2 is the multiplier. Next one. If she chooses constant ratio plan, she will use 60:40 as the ratio. Okay, 60:40 ratio in which plan? Constant ratio plan. EFG. What about the next part? Further, portfolio will be rebalanced each time the Nifty is changing by 5%. So change, rebalance when 5% change takes place. All right. Now down. You are required to evaluate the portfolio position if after 10 days of the first of rebalancing, it becomes 5122. Okay, wait. Here what I will do is, I'll just find out the maximum loss now. So maximum loss will be 5326 minus 4793. That will give you the loss from 5326. If I'm not wrong, you will get the maximum loss as 10%. So once you get this 10%, you will get the floor value. So here the floor value will turn out to be 3 lakh minus 10%. That is equal to how much? 2,70,000. This is actually a very good question, friends. Mark it as a good one. In my regular class, I have done a Sunidhi problem and we have done constant proportion. They have clubbed these two into one. So anyone can now solve this one problem. You get exposure to two separate areas. All right. Right. Let's just continue doing it now. Okay. So I think you got 2,70,000. So first we will do it using buy and hold strategy. So I'll write down working note number 2, buy and hold strategy. This is a very, very simple strategy. In this, okay, what will be the amount that will be invested on the first day? 3 lakhs or 30 lakhs? 3 lakhs. Point number B, value after 10 days. So now what happens is after 10 days, there will be a rebalancing. What has I told? After 10 days, it will become 5122.96, correct? 3 lakh was the value when the Nifty was 5326. Into what is the second day value that we found out? 5122.96. So now tell me 3 lakh divided by 5326 into 5122.96. Do you get the answer as 2,88,563? Correct? Then I will write down value after 20 days. 20 days means after the next 10 days. 10 days further. So after a gap of 20 days, it will be 5539.04. Into 5539.04. Three lakh 12,000. So this is the closing value under what strategy? Under buy and hold strategy. All right, friends. I believe you are all done with this. But next one. Now I'll go to the next part. I'll write down the next working note. Constant proportion portfolio insurance policy. Okay. In this, in order to find out the value to invest in equity, we have to use a formula. What is the formula that we have to use? Portfolio value minus what? Minus the floor value into the multiplier. So when you do this, it will be 3 lakh minus 2,70,000 into what? 2. So do you get the answer as 60,000? Therefore, value to invest in RF will be 2,40,000. How did I get this 2,40,000? 3 lakh minus 60,000. All right, I believe you're all clear with this. So once you get this, then I will write down step number 1, rebalancing after how many days? Rebalancing after 10 days. So I'll draw a table, particulars, then I have equity, then you have RF, and I have total. Okay. So originally, how much is the amount in equity? I have 60,000. And in RF, I have how much money? 2,40,000. Do I get the total as 3 lakhs? Okay. Now, I will just put revised value. So what has happened after 10 days? The Nifty value has come down to 5122.96. So it will be 60,000 into 5122.96 divided by the base value. What was the base value? 5326. So do I get the answer as 57,712? Correct? This will remain at 2,40,000. So when you add up these two, you get 2,97,712. At this date, I will do rebalancing. So I will use the same formula again. What is the formula? Portfolio value, that is 2,97,712 minus the floor value into the multiplier. Do you get the answer as 55,424? Correct? Okay. So now what happens is when you do the rebalancing, earlier it was 57,712. Total should be 2,97,712 only. No change in that. So 2,97,712 minus 55,424 if you do, here you will get 2,42,288. So 57,712 minus 55,424. Here 2,288 I will have to sell. And I will have to buy bonds for the same value of 2,288. So we are done with rebalancing for the first slot. Can you please scribble down this? All right. Can I go to the next part? You want me to explain C, Gokul? Gokul, what is the formula that we have used for rebalancing over here? Portfolio value minus floor value. Am I right? So here the portfolio value has become 297,712. Got it? Okay. So I think we are done with rebalancing after 10 days. Now I will write down step number 2. What will be step number 2? Rebalancing after how many days now? After 20 days. Particulars, you have equity, and then we have RF, and we have total. Point number A, I will write down the opening value. So how much is the opening value? Dakshinamurthy, give us question change. 5% is for constant ratio plan, Dakshinamurthy. That's the next one. I'm coming to that. Okay, let me finish the CPPI first. So in CPPI, what have they told is 55. First, I'll put the opening value, that will be 55,424. Wait, 1 minute. Can you all hear me? George, are you able to hear me now? Okay. 55,424. Okay. Next one. 2,42,288. 2,42,288. 297,712. 297,712. All right. Now from this, I will go and find out the revised value. Okay. So now what will be the revised value? The new value is 5539.04 divided by 5122.96 multiplied by 5539.04 divided by 5122.96 multiplied by 55,424. You'll get the number as 59,925 This will remain the same. So this plus this together will give you the value as 3,02,213. Now what will I do? Again, I will do rebalancing. Now what will be the formula? Portfolio value minus floor value into the multiple of 2. Do you get the answer as 64,426? Okay. So total should be 3,02,213. So the other one would be the balancing figure 64,426. That is 2,37,787. So when you take the difference, you will get 4,501 will be your buy over here. So I should sell this as 4,501. So friends, we are done with constant proportion portfolio insurance policy. Next, we have to do what? The constant ratio plan. All right, friends, are you all done with this part? 5% is for constant ratio. I'll do that next. Clear till here? Okay. Next one. What is the next one? Next working note. Constant ratio plan. Okay, so here what we'll do is we will put day. So I'll put the day as day number 0. Then you have day number 10 and day number 20. All right. So on day number 0, what is the proportion they have told for constant ratio plan? 60:40. So total 3 lakhs is there, right? So in equity, this fellow will invest how much? 60%. That is 1,80,000. RF will be how much? 1,20,000. Total value will be how much now? Total value will be 3 lakhs. Are you all clear so far? This is a constant ratio plan till here. 3 lakhs. Then 1 minute. I will put the Nifty value also over here because the value is changing based on the Nifty, right? So what was the Nifty at the first date? 5,326. Okay. That's it. Let me keep it this way. Whatever extra is required, we'll do it afterwards. After 10 days, this will become 5,122.96, correct? So what is the percentage change that you get over here? 5,326 minus 5,122.96 will give you 203 fall from a base of 5,326. So there is a fall of 3.81 percentage only, correct? So is it going above 5 percentage? No. So what will happen here? Equity will turn out to be 1,80,000 divided by 5,326 into 5,122.96. It will become 1,73,138. This will remain at 1,20,000. Total will be 2,93,138. All right. But no rebalancing required because it is less than 5%. On the 20th day, the value will become 5,539.04. So if you look at this, that would mean 5,122.96 minus 5,539.04. It goes up by 416 from a base of, yes, it goes up by 8.12%. Okay, so now what happens is 173,138 divided by 5122.96 into 5539.04 will give you the number as 1,87,200, 1,20,000, 3,07,200. Now I will do rebalancing. So I'll write rebalancing. Ratio is 60-40. 3,07,200 into 0.6 will give you 1,84,320. Sorry, friends. 1,22,880. Total will remain the same. Okay. So now if you see over here, 187,200 is reducing to 184,320. So here you are going to sell 2,000 to 880. Here you are going to buy 2,880 units is not given. So I will skip that. We are done with constant ratio plan. Let me check, friends, whether the answer is correct. I'm doing that for the first time. 3,07,200 is what I got. 2 lakh. Buy hold strategy, how much we got? 3,12,000, correct? Okay, buy hold, they have done it slightly differently. I'll come to that part. CPPI, our answer is correct. Constant ratio plan also 3,07,200 is what they have got. 1 minute. Constant ratio plan, we got 3,07,200. They also got 3,07,200. And they have done 1,84,320, 1,22,880. Perfect. 2,880. This is correct. Buy hold strategy, they have 1 minute, 10%. Okay. Friends, buy hold strategy. Let's read the question. I don't think they have done it correctly. Okay, what they have done for buy hold strategy is that I'll just give a in reading pen. Okay, buy hold strategy as per ICAI. That doesn't look to be correct to me, but I'll just put it for you to understand how they have done it and how we have done it. Our answer is actually correct. What they have done is they have used constant proportion portfolio. So the initial investment they treat it as 60,000, 2,40,000. So what is the total that they get over here? They get the total as 3 lakhs. Then after 10 days, they will just play around with 60,000. So that will be 60,000 divided by first day value is how much? 5326 into 5122.96. 57,712. This will remain at 2,40,000. Total will become this much. After 20 days, this again divided by 5122.96 into 5539.04. 62,400. And this will be 2,40,000. So you will get 3,02,400 as the value. 31. Sorry, they have not even put 60. They are putting 30,000. They are not using a multiplier of. They have put 30,000 here. 2,70,000 here. Total will be 3 lakhs. Then they are doing 30,000 divided by 5326 into 5122.96. 28,856. 2,70,000. 2,98,856. Last one, 28,856 divided by 5122.96 into 539.04. 31,200. Friends, this answer is not correct because when you do buy hold, what is the meaning of buy hold strategy? You buy and you hold. So you buy entire 3 lakh in equity actually. But ICA has done it this way. So exam point of view, follow this. Logically, this is not a correct answer. All right. Can you scribble this down and finish it off? All right, so we are done with this. You want the previous slide? Yeah, but you will not have time to give alternative view in the exam, Sarvamangala. Are you all done? Okay. So friends, time is 1 o'clock. I need to pack up now. How many questions are left for us to do? One question is left over here. Follow ICI, Sarvamangala, for time being, because that will be the suggested answer. This is easy. We can do this. One question is pending. Then we have a question on valuation. Then we have an interest rate derivative. 3 more questions are there, is it? 3 and 4. The above one is also there, correct? So I think we'll need 2 more hours. Let's take a break now, friends. Can we sit back again at 3:30 p.m.? Are you all free? So we'll sit 3:30 to 5:30 and we'll finish off with MTP second part at least. Then the session 1 alone, we'll keep it to the next week. We'll do it someday and we'll close it in one slot. In the morning, we'll sit and we'll finish it off. All right? Right. Fine, friends. So I'll see you back at 3:30 p.m. today. Let's pack up with this MTP also today only. Okay. Thank you so much, friends. I will see you at 3:30. Take care.